Some hedge fund managers make more than $1 billion a year, even when they lose your money. That's not a typo. These guys take 2% of everything you give them, whether they make a single profitable trade or not. Jeffrey Epstein supposedly ran one. Steve Cohen got fined $1.8 billion for insider trading and still came back richer than ever. And the wildest part? Regular people like you and me, we're not even allowed to invest with them. So what the hell is a hedge fund really? And why does Wall Street want to keep them hidden from you? By the end of this video, you'll understand exactly how hedge funds work, how they always manage to make money, and why they're designed to keep you out. Let's go. Okay, so let me break this down like you're my friend at a bar. A hedge fund takes money from rich people and big institutions and invests it in pretty much anything. Stocks, bonds, currencies, commodities, derivatives, stuff most people have never even heard of. Pretty simple, right? Except here's the thing. These guys aren't your average money managers. They're supposed to be the market wizards, the geniuses, the ones who make money no matter what the market does. Markets on a tear? They better be beating it. Markets crashing? They better have predicted it and set themselves up to profit in advance. In fact, the #1 unwritten rule of hedge funds? Never lose money. But wait, if they're not supposed to lose money, how do they always get paid even when they do? I'll explain that scam in a second. But first, you need to understand who's even allowed in the door. Here's where it gets interesting. Unlike mutual funds that anyone can buy into, hedge funds are not open to the public. They're only for what's called accredited investors. Translation? You need a net worth of at least $1 million, or an income of $200,000 a year, minimum. So right off the bat, this game isn't designed for regular Americans. It's designed for people who are already rich, and once you're in, it's the Wild West. Hedge funds are barely regulated. They don't have to tell anyone what they're doing. They're so secretive that they only reveal their trades once a quarter, after the money's already been made. They use strategies that would make a casino blush: short selling, leverage, derivatives, algorithmic trading. Let me explain leverage real quick because this is important. Imagine you have $100. With leverage, you can borrow money to control $1,000 worth of investments. If your trade goes up 10%, you just made $100 on your original $100. That's a 100% return. But if it goes down 10%, you just lost everything, and then some. As Warren Buffett says, if you're smart, you don't need leverage. And if you're dumb, you shouldn't use it. Now here's where the real scam comes in. Remember how I said hedge funds always make money? Let me show you exactly how they do it, even when your money disappears. The typical hedge fund fee structure is called 2 and 20. 2% management fee, 20% of profits. Sounds reasonable, right? Wrong. That 2% fee, they take it whether or not they made you a single dollar that year. Win or lose, they get paid. Let me put this in perspective. Ken Griffin runs Citadel, one of the biggest hedge funds on the planet. They manage around $65 billion. That 2% fee alone brings in $1.3 billion a year, before they make a single trade, before they generate a single penny of profit. $1.3 billion, just for showing up. And if they do make money, they take 20% of that too. In 2022, while the rest of us were watching our 401ks get destroyed by inflation and rising interest rates, Citadel's flagship fund gained 38%. They made $16 billion that year, the largest single-year gain in hedge fund history. Ken Griffin took home so much money that he casually dropped $500 million on a couple of paintings back in 2015, just because he could. But Ken Griffin isn't even the craziest hedge fund story. Wait until you hear about the guy who literally broke an entire country's economy in one day. Let me introduce you to some of the biggest names in hedge fund history. George Soros. In 1992, the UK had an agreement with Europe to keep the British pound within a fixed exchange rate. But Soros saw weakness. His hedge fund, the Quantum Fund, borrowed billions of pounds and immediately sold them. This put so much pressure on the currency that on Black Wednesday, the UK was forced to abandon their agreement. The pound collapsed. How much did Soros make? $1 billion in a single day. He literally broke the Bank of England. Jim Simons. Ever heard of him? You probably should have. His average annual returns are almost triple Warren Buffett's. This guy was a mathematician who cracked codes for the NSA during the Cold War. Then he started a hedge fund called Renaissance Technologies. His flagship medallion fund, average annual return of 66%. If you invested $1,000 with him back in 1988, today it would be worth around $140 million. Steve Cohen. If you've watched Billions on Showtime, you basically know this guy. Bobby Axelrod was loosely based on him. Cohen's former firm, SAC Capital, made billions in the 90s and 2000s. Only problem? They were doing it illegally. In 2013, they got fined $1.8 billion for insider trading, one of the biggest financial scandals in history. The firm was shut down. Traders were arrested. But Steve Cohen? Never personally convicted. Instead, he paid his fines, rebranded, started a new hedge fund called Point 72, and it now manages over $30 billion. Oh, and he bought the New York Mets. Because why not? Now you might be thinking, okay, these guys are clearly playing a different game. But what about when hedge funds lose? What happens when the smartest guys in the room get it wrong? In the 90s, there was a hedge fund called Long-Term Capital Management, founded by a former Wall Street trader, staffed with Nobel Prize-winning economists. These guys thought they had cracked the market, and for a while, it worked. From 1994 to 1997, they were delivering massive returns. Wall Street couldn't throw money at them fast enough. But remember what I said about leverage? These guys were leveraging their trades 30 to 1. For every dollar they had, which was about $100 billion, they borrowed 30 more. Then in 1998, Russia defaulted on its debt, something their fancy models said would never happen. Within weeks, they lost billions. And because they were so interconnected with every major bank on Wall Street, their collapse threatened to take down the entire financial system. The Federal Reserve had to bail them out for $3.6 billion. Long-term capital morons. So here's the bottom line. Hedge funds are the most powerful, secretive financial machines on the planet. They manage trillions of dollars. They can make or break entire economies. And they play by completely different rules than you and me. They charge fees whether they win or lose. They use strategies that can multiply gains or wipe out everything. And the people who run them? They've built a system where they get rich no matter what happens to your money. Is this fair? Probably not. But here's the real lesson. The game isn't designed for regular people to win. It's designed for people with information advantages, access, and enough money to take risks that would destroy the rest of us. So what can you do? Understand how the system actually works. Stop chasing secret investment strategies and focus on the boring stuff that actually builds wealth over time, like low-cost index funds, consistent investing, and staying in the market for decades. That's how regular people actually win. If this video helped you understand hedge funds, smash that like button. It helps more people see this content. Drop a comment below. Did you know hedge funds charged fees even when they lose money? I want to hear your thoughts. And if you want to learn how regular people can actually build wealth without playing Wall Street's rigged game, subscribe and hit the bell. I've got a lot more coming. I'll see you in the next one.